Hey there, finance friends. Welcome back. So, we put some time into this retirement thing. We've learned the conceptual ideas, the systems thinking, and we just built up a pretty intense but a really useful model to figure out how to go from planning to estimating your Dow to determining how much to save. The final thing we have to do now to put it all together is now that we've figured out, so for example, we said that we need to save 377 a month. Okay. We just made that up for our example. We have learned in our systems thinking, I've taught you in previous lectures that when you have your income, you're going to want obligations, luxuries, and savings and investing. And we have used kind of the rough numbers of 50%, 30%, and 20%. So doesn't matter how you do it, you're going to want to start saving and investing money for future you. Okay? We've tied it into our systems lens. Now we have to answer one last question. You're going to say that you decide that you're going to save and invest your money. We've learned about index funds, good stuff. But then the question is, what vehicles do you use? In other words, in this little lecture, we're talking about retirement accounts. Remember, we invest in assets. We invest through accounts. In other words, the accounts are the buckets that hold our assets. These arrows here represent the contributions that we make. Once the money goes in the bucket, we're going to buy assets with it. We're not going to leave the cash in the bucket. We're going to buy, probably index funds. But the question is, what is the nature of the bucket? So we're talking about accounts. And I want to give you a brief overview on retirement accounts, do a quick compare and contrast, and then I want to focus a little bit on 401ks in particular, because for most of you, those will be the real key tool that you use for your retirement. Okay? So let's talk about our accounts. And let me just clean this real quick. So when we talk about accounts, I would encourage you to think of retirement accounts by the nature of how they are formed. We have one group of accounts, which are individual accounts. We have another group of accounts that are employer-sponsored accounts. And we have a third set of accounts that are specifically designed for the self-employed. Okay. It's important to note all of these accounts that I'm going to teach you, number one, are buckets that hold your money. Number two, the accounts that I'm going to teach you are specialized retirement accounts. These often go by the term tax-advantaged retirement accounts. And this is because all these accounts that I'm going to describe, all these specific buckets to hold your retirement assets have been authorized by the tax codes of the United States to incentivize you to use them. They give you amazing tax benefits. But the flip side is, once you agree to put the money in those buckets and you accept those tax benefits, you're also promising the government that you're not going to take that money out for a real long time, for decades. So there's a trade-off there, which we addressed in our first video in this segment. Okay? In any event, Let's think about the different types of accounts that we have access to. These are, again, retirement accounts. They are buckets that hold our assets for retirement, and these buckets travel with us through time, holding our retirement assets and giving those assets very, very favorable tax advantages. The individual accounts are the traditional IRA. An IRA stands for an individual retirement arrangement or an individual retirement account. The traditional and the Roth. These are accounts that you can set up as long as you've worked in a year. Okay? As long as you have worked and earned income in a year, you are eligible to set up an IRA for that year. And again, it's individual because you set it up. The second group of accounts are what we call employer-sponsored accounts. These are retirement accounts that are set up by your future bosses. They're run by companies. So the companies, the employer sets up these accounts, and then you and I, as employees, we have the right to participate and to contribute to these accounts. Okay? These, just so you know, are also known as DC accounts, defined contribution. So that's the same term. That's a synonym. Defined contribution accounts, those are the accounts that your bosses set up. There's a few. The most commonly known one is the 401k. There is also an account called a 403b. And there's an account called a 457. Don't let the jargon, don't let the argot mess with you. These all behave the same way. They're just set up for different types of employment situations. So the 401k, the 403b, and the 457, those are three different types of buckets, but for all intents and purposes, they behave the same and offer you the same advantages. So then you say, well, Eric, what's the difference? Well, 401ks are offered by for-profit firms and corporations. 403bs are the equivalent offered by nonprofits, and 457s are an equivalent that's offered by particular employers. Like, for example, the California State University system. If you work for the CSU system, you would have a 457 plan, okay? So these are the three types of accounts that employers offer. It is worth pointing out that in addition to a traditional 401k and 403b, there are now options for a Roth 401k and a Roth 403b. And we'll discuss that in a bit. And then finally, there are plans for self-employed people. Because you think, well, that's not fair. Like, I don't work for a company, I work for myself. It's okay. The IRS has you covered too, because there are a handful of self-employed accounts that are set up for self-employed people. And those would include what's known as a SEP IRA and also a plan known as a Keogh plan. So it doesn't matter if you work a traditional job or if you're self-employed. If you're in the private sector or the public sector, you have access to a lot of tools. Let's briefly contrast IRAs with 401ks. Okay, an IRA is set up by you. A 401k is set up by your employer. Note that you're allowed to double dip. This is a very good thing. So if you have a job and your employer offers you a 401k, you can contribute to that while simultaneously contributing to your own IRA. You can double dip. This is a good thing. Gives you a chance to sock away a lot of money. Okay? In 2026, the maximum contribution to an IRA is $7,500 for most taxpayers. But the maximum contribution to a 401k or the 403b equivalent is $24,500. So they're both great plans and you can use them together. But if you notice, they differ in that the 401k plan has a far bigger contribution limit. So you can put a lot more money into those plans. You can stuff your bucket with a lot more cash to buy more assets and grow that nest egg more rapidly with the 401k. So those are those differences. Let me also briefly address the difference between traditional plans and Roth plans. So let's compare and contrast the Roth IRA with the traditional. Well, they're both IRAs. So they both have a contribution limit of $7,500. But here's where it gets interesting, and I'm going to use some jargon, but we'll get through it. Roth IRAs are funded using what we call after-tax dollars. In other words, if you set up a Roth IRA, the money that you contribute into it, you've already paid taxes on. Okay? The money that you contribute to a Roth IRA is money that you've earned and already paid taxes on. In contrast, a traditional IRA, it can be funded with after-tax money. Or, and this is an important provision, traditional IRAs can be funded with pre-tax dollars. You think, what does that mean? What do you mean pre-tax dollars? Well, if you think about, you get paid, your boss takes taxes out, and then you get your paycheck. You get paid, you have like your gross pay, your boss takes out all your taxes, you get what's left over. The amount that you get is after-tax dollars. You can fund your Roth or your traditional with that. But with the traditional, you can also fund it with pre-tax dollars. And what that means is you can get a tax break with a traditional IRA. So let's say that you make $50,000 a year in your job and you decide to fund a traditional IRA and you put $7,500 in. You get a tax deduction from that. That's why you'll hear people say something like, you'll often hear people say, oh, I got to open a Roth to save some taxes. I'm sorry, I have to open an IRA to save some taxes. Yeah, you can save some taxes, kick into your retirement account. You think, what's the connection? What's the causal link? It's here. With the traditional IRA, only traditional. With the traditional IRA, any contribution that you make is reduced. Sorry, any contribution that you make is applied against your income. So you would hypothetically, let me clean this up, try it again. With a traditional IRA, if you had an income of $50,000, you would list that on your tax return, and then you would have a deduction for $7,500, and you would only have to pay tax on the difference. So we say that a traditional IRA is funded with pre-tax money because this money, you get a tax break on it. You reduce your income by it. You get a tax break today. This is not bad. This is not bad at all. The Roth IRA, on the other hand, does not give you a tax break today because the Roth IRA is funded with money that you've already paid taxes on. So, not now, but rather later. Contributions. So you have your money in your bucket. You're earning money you're contributing money every year. Remember, you're contributing income into your bucket, you know, it's your bucket. Actually, no, let's do it this way. You're contributing money into your retirement account. You're buying assets. You're holding those assets in your bucket. Those assets are going to grow in value, and those assets are going to generate cash income, and that's going to flow back. And it's going to go again, and it's going to flow back and flow back. And we've talked about that arrow getting fatter and fatter. Good stuff for you. Well, you're making cash income and you're growing your assets. If you were in a traditional brokerage account, a non-tax advantaged plan, just a traditional brokerage account, you're having to pay tax every year. Every year you're paying tax. And this is not good because that's a leakage. So you're going to have less money being fed back in. Then it grows, then some taxes taken out, and your arrow is skinnier. Well, the contributions here grow for a Roth IRA tax-free and for a traditional IRA tax deferred. In other words, you pay no taxes on any of the cash or growth that your bucket generates. This is magic because it gives you full compounding. Remember, we want to keep putting money into our bucket and we don't want any leaks. We don't want any holes in our bucket. Taxes is one of the biggest bucket holes. Well, these plans, because they grow money tax-free or tax-deferred, they don't have a hole for taxes. All your money stays in the bucket and it grows rapidly because you get full compounding. This is good. And it gets even better for the Roth because we said that with the Roth, you're paying with after-tax money. Since you've already paid taxes on it, way down the line, when you decide to take money out of your Roth IRA and you take your withdrawal, in your withdrawal phase, your withdrawals from your Roth IRA, tax-free. Imagine that. Imagine going into retirement, you got $750,000, maybe $1 million in your Roth IRA bucket, and you know, man, I can take that money out and not pay a dime in taxes. Amazing. What a tool. You've got to consider opening your Roth IRA. Now, with a traditional IRA, because you took the tax break early on, you're going to pay taxes when you take the money out. Taxes are paid on your withdrawn money. But that's okay because you grew it tax-free. Okay? You'll have to make the decision, and there's a lot of advice out there in articles, but just know either way, whether you go Roth or traditional, you want to set it up. You want to benefit from that tax-free growth. If you want to have tax-free withdrawals, set up your Roth. If you want an immediate tax deduction, set up your traditional. And those are your tools. Okay? In our final minutes together on retirement, I want to address briefly the 401k and just a couple of basic ideas about it. You really need to set this up. Okay. If I were to tell you, hey, listen, I can give you only one piece of, I mean, I can give you a lot of advice, but if you said, Eric, you can give me only one piece of advice, so make it count. And if I thought about everything in personal finance, I would say open a 401k. Okay. This is a powerful tool that offers many, many benefits to young investors who are working. What are some of the benefits? Well, benefit number one, a 401k puts in pre-tax money. And this pre-tax money basically means you get an immediate boost. What does that mean? Well, let's just say that you are going to, let's say they have a 401k, it's sponsored by your employer, and you're going to put $1,000 per month. So let's say you get paid twice a month, you're going to put 500 bucks per paycheck, have it automatically put into your 401k. At the end of the year, you're going to have $12,000 contributed, and it will have only cost you 12,000. You think, yeah, of course. Well, think about this. If you were to contribute after tax money, see, this is pre-tax money. If you were to contribute after tax money, 12,000 divided by, let's say that you had a 25% tax rate. 12,000 divided by 1 minus 0.25 is 16,000. What does that mean? Well, if you were going to use after-tax money, you would have to earn 16,000 so that after your taxes, you were left with 12,000 to actually invest. But with the 401k, because it's pre-tax, you just put in 12. You don't need to earn 16 to keep 12. It's pre-tax money. And since it's pre-tax money, it's going to give you an immediate 25% boost on your earnings. Amazing. A second benefit, it's automated. You set it up with your employer and it comes out of every paycheck. It's automated. And this is important because we've learned that automation is better than emotion. We've learned that systems beat intent. Here's the way it looks from a systems lens. Usually, you would have income, and then you would take taxes, and then after taxes, you have your net income, and then you put in your 3 buckets, including your savings bucket and your investing bucket down here. So you're putting money in that's after tax. Well, this is the way the 401k looks. You have your income. The first thing that's taken out is your 401k money. Your investing comes out first. Then after your investing, then your taxes come out. And then from there you get your net income, which you then deploy to your obligations, your luxuries, and your savings and investment. This is a phenomenal systems thing. You're taking the money and investing it before anybody else touches it, before the government touches it, and before you touch it for day-to-day living. This is what we mean by pre-tax money. And it's powerful because not only is it automated, but because you're automating it to your own future self, because you're automating your investments before you pay the government taxes and before anything else, you're engaging in our most critical rule. PYF, pay yourself first. You want to pay yourself first? Set up the 401k. So now you're talking about tax benefits. Check this out. Because your income is here and then money comes out, it's also going to lower your taxable income. Think of it this way. If you make $100,000 a year, but you're putting $12,000 into your 401k, that money's going away before you touch anything. So you're only actually receiving $88,000 in pay. And this is the basis of your taxes. You can make $100,000, but only pay taxes as if you made $88,000. It lowers your taxable income, and therefore saves you taxes. It's like a win-win-win. You're paying yourself first, you're automating, you're lowering taxes, and there's one even bigger thing, the match. Most employers have a 401k plan with a match. So they'll say something like, up to your first 5% of income for every dollar you contribute, we'll match it. Think about that. Your employer says, hey, look, we want to help you out. We want to help future you. If you put some money in to your bucket, into your 401k, the employer says, we'll give you a match. It's free money. And I know that you're not going to leave free money on the table. So this right here, my friends, is the power of a 401k. You really need to set one up. In fact, I would encourage you that when you get those first jobs or when you switch a job, the very first thing that you do once you've accepted the job, thank you very much, boss. Nice to meet you. Looking forward to working with you. By the way, can I get my 401k sign up paperwork? Because I want to get in this thing and I want to start it with my first paycheck. Okay? One last thing, actually, tied to that. I just thought of it. What happens if you change a job? Suppose that you have a 401k and you decide to change your job. Well, you have four options. Number one, you always own your 401k money. It's yours. So if you get a new job with a new 401k, you can roll over your old 401k to your new one. You can transfer your 401k to your own IRA. You can leave it in your old company's plan. That's allowed as well. All three of those are fine. You can roll it to your new 401k. You can roll it to your IRA. You can just leave it in your old company's plan. Those are three options and they're all fine. There is a fourth option. You can cash that money out. And that's a no-no. No, 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 no. Okay? The fourth option is you leave one job, you've got money in that 401k, you can just like cash it out and take the cash distribution. Do not do that. You will pay heavy taxes on it and you will lose the ability to compound because taxes are a big hole in your bucket. I've had tax clients who do this move. It's not uncommon that when they prematurely cash out a 401k, when they leave a job and they cash out that 401k, they are generally giving up in taxes and penalties 40% of the value of that bucket. How are you going to get wealthy when you're giving away only 40%? Remember, we want to minimize the leakage. Here's your 401k. I'm out of room. I'll do it right here. Your 401k is a bucket. That bucket, you're going to put money in every month and you're going to grow. The beauty of the 401k is we had said before that holes in your bucket, leakage, affects your compounding. Well, the beauty of a 401k, there's no holes. This thing right here, the tax-free growth, there's no holes. It's a beautiful thing. But if you cash it out early, if you take a premature distribution, that's a big gaping hole that's going to probably push 40% of your money out of your hands into the government's hands. And I don't want your money in the government's hands. I want your money in future use hands. So take advantage of a 401k. Okay. And that, my friends, is a very comprehensive, and I know technical, but it's a lecture on retirement. And I hope that now you have a basis of knowledge to plan well. If you have to summarize, what are the golden rules of retirement planning? We're going to start early. We're going to save at least 15 to 20% of our income. We're going to open a 401k and we're going to get the match. We're not going to leave free money on the table. We're going to make good use of tax advantaged accounts. We're going to understand how the IRA works, how the 401k works, traditional versus Roth, and we're going to take advantage of those accounts. When we put the money in the bucket, we're not going to leave it as cash, but we're going to buy assets wisely. Probably mutual funds or index funds. We're going to diversify our investments. We're going to stay consistent. And then finally, because retirement's a process, we're going to review annually. Every year, take about 15 minutes and just check your balances, check your allocations, and make sure that what you're doing ties into your goals. Follow those golden rules and you'll be fine. Avoid these mistakes. The most common errors that I see people make, they wait too long to start. They don't open the 401k if their boss has it. They cash out early. Well, you know that that's a big hole in your bucket, and they rely on only one source of income. We're going to save a lot of our money, deploy it to assets, build lots of different nest eggs in lots of different accounts, play this game wisely, and one day future you is going to have a big roaring river made up of lots of powerful streams of retirement income. That's the future that you deserve, and that's the future that I want for you. That wraps up our retirement. I hope it was helpful. If you have any questions, reach out, and I will see you next lecture.